All right, this is the stock market analysis, S&P 500, and I'm also going to bring in the Nasdaq also because I think it's important to do that based on this analysis. And there's relief rallies coming. We may be in one right now as here we are recording on Friday, and we've had some very severe drops where just the last 2 weeks the market fell by over 10%, and that is one of the biggest drops we've seen in a long time. So generally you get that, you get relief rallies. Where will they go to? And when they fail, how far will they fall? There is so much talk out there that the market is going to make a bottom, and it's the investors are always sure the market will make a bottom in the long term. You have to just sit through all of these, and the market keeps going up. There are times when that is very difficult to do, as the markets fall 30, 40, 50% in bear markets, and bear markets tend to last on average over a year and fall by over 30%. So they tend to be very difficult to sit through. And it's just this take it for granted attitude that you can sit through these bear markets and they'll just be moving up again and move up to new highs and big recoveries. And we have thought that would be a false assumption for the market over these next months. And maybe well into 2023. So there will be big rallies. They will look good. But what the central banks have to do is a very giant task, because they have gotten themselves in a terrible situation with micromanaging these economies and keeping massive bubbles blowing in assets, and even the earnings levels have been in a massive bubble. And the S&P 500 earnings that all the analysts look at are based on bubbly assumptions. And that's not going to be the case. The earnings recession is going to hit, and the whole concept of that, okay, we're at 17 times forward earnings, and that's the average. Well, that's silly, because in bear markets, I've seen them go to 12 times or worse. So, of course, I've been around 48 years and seen all of the bear markets since 1973. So that's quite a long period of time, would you say? So there are not a lot of people still in the markets that can say that they have been around trading these markets for that period of time. So I feel good about that. So let's take a look here as we look at the S&P 500, and then we'll switch over and also look at the Nasdaq. So here is that S&P 500, and what we're looking at is the whole period from the panic lows all the way over in 2020 over to where we are right now. And what's important to see is that this right over here suggests that this whole thing was this historic everything bubble that's going on that created the Bitcoin and NFT nonsense, the crypto nonsense, and SPACs, and all of those bubbly gambling vehicles that people went into as the valuations got too incredibly high, historic 200% of GDP on the valuation in the stock market. And now over here, as you can see, now labeled as the Great Reset, from the really horrible setup, now the third one in 24 years that the government and the Fed has set up, that now investors have to sit through, and so many will be bloodied or already have during this period. So let's take a look at where we are right now as we're projecting the market in here. So I'm just going to come down and look at the cycle periods that we're looking at right in here. So these are the minor cycles right there, and they're running around 9 weeks. This is the dominant cycle right over here, running around 27 weeks. And these are the minor thirds. You can see there was a minor third cycle right in here and a minor third cycle right there. So breaking this low right there, and that was negative right there, breaking that low, and then breaking this low right over here was also negative. And now once you begin this new minor cycle and it fails up in the resistance area right there, and it fails early in this cycle, we call that a left-hand translation. It's very negative when it fails early in the cycle because it has all that time period to fall, and you can see our projection over here. This is the these are the fib extensions that you see here. This is the 61.8% fib extension that you can see labeled right over here where it has gotten down to. And then this is the 78.6 and this is the 100. When you see this color, it's our target zone that we're looking at. And that would, it's taken you down now past the 61.8%. And now, we've got all this white space over here and there's room to rally. The sell zone comes in here. It begins somewhere around 38.45. So there could be a 200 point or more rally in the S&P 500 within this declining phase that it's now in. And then if were that to happen, it would be likely that it would get down here to about 35.35. That's where the target is right there. These lower targets right over here, which are 33.50, and then this major 61.8% at the bottom, right around 3,200. Those I think are going to come in later. So we look at this July period for the minor cycle right in here, falling down to about 3,500. This is 34.95. The top of that at the 78.6 is 35.35. So that's what we're looking for. A lot of, zigzagging here and getting down to 35.35. And then another attempted rally out over here in the summertime period, maybe rallying out into August and then getting wailed on again. These yellow areas that you see are the periods of risk, those yellow ovals, and they bring the largest decline. So looking at this, that largest decline is out there coming out into that September time frame, and that's where we think you could see the market really get slammed. That's very reasonable, and you can see there's a red projection right over here that it gets down to that area around 3,200 in the S&P 500. An outside chance, if the market wanted to be much stronger, that it stops in this area of about 3,500. But that would be a pretty optimistic projection, in my opinion, looking at this, especially looking at the magnitude of the declines. S&P 500 so far has given up 24.4%. The fact that you had to wait for 20% to get it declared a bear market, I think, is one of the stupidest things that we ever hear from analysts. But that's what they like to do. In the meantime, the Nasdaq and the Russell had been down well over 30% for many weeks. It's officially they call it a bear market. But, look back in January, we said this was a bear market year, and I repeated that. So here is the projection, as you can see. And if you look out over here, this message right there, it's possible that the bear market low projection goes out to April of 2023. And I give that a pretty high possibility that you could get this bottom here in September, get a nice rebound. I mean, where the market puts on something like 15%, even 20% on the upside, and everybody thinks it's safe, and then a huge decline again after that out into April. If I look at this cycle right there and highlight it, that takes you out to April 2nd. That's another what we call complete harmonic family out there. And the fact that, the possibility of the bear market ending here in September, I think is a very low possibility when we look at that. So September, October, nested bottom in line with the monthly cycles that we look at, which is the beginning of the time frame for the monthly cycle to end that goes all the way out here into early 23. So there's going to be a lot of continued downside pressure from longer term patterns, and that is a problem. Here you can see in here where our reversal scout turned down. You can see that red arrow we put in there to show you. That was the point it said that there's a risk of hard selling, and you can see that's really happened, and the reversal scout is still pointing to the downside right there. So that's the S&P 500. Projections down to 3,500 right over here approximately, potentially down to 3,200 here, with the possible bear market going all the way out into April of 23. That's not something that anybody else is saying. Let's take a look at the Nasdaq Ndx, and it's going to be a fairly similar story when we look here. We'll just bring this all down and bring you from the top here to those lows right there. Okay, so what we're looking at here is a very similar situation. As we see in here, the minor thirds on these cycles, the nested area where the biggest declines come into, the breakdown of the first minor third, the breakdown of the second minor third, the projection out over here. Now, you see this projection took you down to that 50% extension, which is what it hit today or this week. This actually is likely to extend further down. That next extension right over there is around 10,500, so we'll be actually wanting to lower it there, and that's kind of the bottom of that downward channel that it's been trading in, as you can see. So that is 10,500, and then the top of that fib extension right over there is just under 10,000. The bottom of it there is very near 9,000, and that area is that September-October period where all of the indexes sink in timing to come down to. So again, there is possibility that you're going to be able to get a rally in there, but it wouldn't last. You can see in here where the sell zones are. If the market is able to get a recovery, the bottom of that one is at around 11,700. So 550 points from here is where it begins to enter into that sell zone. That's where we would expect it to try to get to in a rebound. And everybody will be celebrating, but that is an opportunity to lighten up again if you haven't been able to do it. The top of that is around 12,200. So again, that range in this sell zone, 11,007 to 12,200. And that is our opinion, the best case that the market could get a rebound into. And then again, projecting down over here, 10,000. That's 10,600, that's 10,525, so that's the idea right there. You get that major 61.8% fib support area, that big thick green line, the 61.8% extension. Here you could see the reversal scout giving you this negative look. When you have a negative reversal scout and you hit in the weekly and you have short-term patterns, short-term momentum conditions, in the shorter term patterns, in the dailies, the 2 hours, the sum of the evidence says that the biggest impulses will be on the downside. So as long as this is pointing down, it's going to be a very negative condition. And we think that that might be able to get resolved a little bit over here in July and August, but then this other potential big decline right over there out into September, October, which is where these nested bottoms come in. So really what we're looking at is the S&P 500 and the Nasdaq in areas where there's a ton of risk. If relief rallies come just because they seem very oversold, it is likely that they will be followed by more severe drops. This is far from over. The actions by the central banks in the world is not only far from over, but in a lot of parts of the world just beginning. And that's really why the action by the Swiss National Bank shook the market up so much, because it really then highlights the fact that there is a lot of work to do in the world. The dollar is likely not going to be a safe haven anymore based on that. And if the Bank of Japan gets in line in here, which I think they're going to have to, then you're likely to see the dollar get some real big hits on the downside. All of that will set up some very good information and upside setups for the metals markets. And I want you to keep your eye out for some analysis that we're going to do on metals that will likely give you some very good opportunities on the upside. Still, we think that the picture for the metals markets is really a second half picture, and that all of this speculative money that has nowhere to go right now may very well go there, as well as finding periods where they buy up the stock market because it looks cheap. Well, it's far from cheap yet, and it was blown up to ridiculous levels for a long period of time, and there is a lot more to go to fix the problems that they created. Fixing the problems that they created.